April was another positive month for markets, with global equities gaining 2.7% and Eurozone bonds 3.8%. Equities were supported by the unprecedented monetary stimulus announced in Japan, which plans to double the monetary base by 2014, and the reduced likelihood of an easing of QE3 in the US due to weaker economic news flow. A positive earnings season in the US, where results to date are approximately 5% ahead of expectations, also lent support, although outlook statements have been cautious and led to marginal downgrades to 2013 earnings estimates. Bonds benefited from the slower economic backdrop, falling rates of inflation, and the eventual formation of a coalition government in Italy. Commodities fell 4.7% on the weaker macro data, with gold down 7.7% on plans by Cyprus to sell part of its gold reserves. As has occurred in each of the last 3 years, global economic data has slowed entering the second quarter. In the US, non-farm payrolls, ISM manufacturing and services, retail sales, durable goods orders and first quarter GDP were all below expectations. In Europe, sentiment indicators maintained their recent weaker trend, while Eurozone unemployment hit a new all-time high. Chinese first quarter GDP disappointed at 7.7% versus expectations of 8%, while PMI manufacturing and other indicators also moved lower. It wasn't all negative news, as releases surprised positively in Japan and the UK, where a triple-dip recession was avoided as first quarter GDP was positive at 0.3%. The global slowdown, however, should prove to be temporary. In the US, the housing market remains firm and supports consumer wealth and confidence, with the consumer balance sheets already at their strongest levels since 2001. In China, electric power usage and cement prices increased through April, indicating a pickup in activity, while the new political leadership are likely to introduce stimulus measures if required. While headline global PMI readings and new order levels have eased, forward-looking investment plans and export orders have been positive in some sentiment surveys, suggesting a recovery in coming months. The significant amount of global monetary stimulus is also supportive of growth, and we believe the current economic soft patch will fade in coming months. The US Fed had hinted that it might begin to withdraw QE3 before year-end. The slower economic data, however, has probably reduced the likelihood of this occurring, and at its most recent meeting, the Fed appeared to back away from an early tapering of monetary support by saying the pace of asset purchases could either increase or decrease depending on the outlook for the labour market and inflation. This chart highlights the impact and importance of monetary stimulus for global equities. The shaded areas relate to periods when US QE programs have been implemented, and on such occasions, equity markets have risen by 3% per month on average. Equity markets, however, have fallen 2% per month on average as QE programs have ended, as can be seen in the chart where markets have tended to decline in the periods immediately after the shaded areas. With stimulus from the US Fed probably remaining in place until early 2014, the significant QE program just announced in Japan, the recent 25 bips interest rate reduction by the ECB with further measures to improve lending to corporates expected, and with possibly additional announcements from the Bank of England, easy monetary policies among global central banks are set to remain in place for the foreseeable future and should continue to be supportive of equity markets. While economic growth has hit a soft patch, we expect this to be temporary and growth to recover through the remainder of the year. We believe equity markets will continue to move higher, given this economic recovery combined with ongoing monetary support, attractive valuations, continued inflows into equity funds, and increasing dividends, share buybacks, and mergers and acquisitions. With yields in core markets back close to last summer's lows, bonds provide limited opportunities at these levels, although peripheral markets still provide some upside.